Inventory includes raw materials, component parts, work in progress and finished goods typically for a manufacturer. And for a retailer or a wholesaler, you'd typically only be thinking of finished goods. Inventory needs to be carried at the lower of cost and its net realisable value. And so let me expand a little bit on costs for you. Costs typically includes three elements. There's the cost of purchase, the cost of conversion, and the cost of getting the goods to the location so that they're ready for sale. Cost of purchase is, I guess as it says, it's the cost of purchasing the goods. But the thing you need to be aware of here is that sometimes someone might offer you a rebate, a discount. Those things need to be adjusted against the cost of the inventory. Or sometimes you might even receive an incentive for paying early, and typically we'd adjust that against cost of goods sold. The cost of conversion is really more relevant to a manufacturer. It's what's gone into the production process. And so what we're allowed to do is include, or we're required to capitalise those costs that relate to the cost of converting the raw materials into the finished goods. So when we think about that, that's things like the depreciation on the manufacturing equipment, but it could also include the overheads relating to the production process. When you're capitalising something like overheads, you need to be ensuring that those costs are allocated on a reasonable basis. So you can't include overheads where they relate to inefficiencies, so idle downtime on equipment, or for example, costs that you've incurred because of excess wastage or loss through the production process. For some of the inventory that you might manufacture, it could take a long time to produce it. Think of developing land, constructing an aeroplane, or building a set of apartment blocks. The literature thinks of these as, or describes them as qualifying assets. And what it requires for a qualifying asset is that you actually capitalise some borrowing costs that relate to the period of time that it took to actually manufacture those items of inventory. When you're considering the costs to include, you also need to consider the costs that relate to getting the inventory to the location where it's ready for sale. So an example might be when you're importing goods from overseas. You might incur the transport costs, the taxes or levies, and these are the sorts of things that you would include in the cost of inventory. The sort of thing we wouldn't include though would be, for example, GST, where in Australia, while you might incur it on the purchase, you can then reclaim that GST from the tax office. So it's not really a cost of the inventory. The sorts of costs that don't relate to the cost of your inventory might, for example, include things like storing finished goods in a warehouse when they're not yet ready for sale. Or it could also include the distribution costs when you're actually having to ship goods to your end customer. There are a few different methodologies that are used to track the cost of inventory. Let me go through them for you. First in, first out deals with the value of inventory and looks at recognising as an expense the cost of the items you bought first, and leaves as an asset the inventory that you bought later on in the period. You'd typically see that perhaps for a distributor. Then there's average cost, which takes the cost of all the inventory that you've purchased and it uses the average of that to measure cost of sales and then also the closing value of inventory on hand, and you might see that in retail. Standard cost, which is very similar to average cost, but what happens is you come up with a standard cost for the product that you might be manufacturing. And then you look at variances between the standard cost and actually incurred costs. So it's typically used in manufacturing, and a good example of where you'd see a variance would be in labour hours, for example. If you incur a lot more time than you normally expect, you need to consider whether that's an inefficiency that should be expensed or whether actually your standard costing is correctly including the labour portion. The last area of inventory is around specifically identifiable. And so really that's saying, I know how much that piece of inventory costs me, and I'm going to use that when I think of my sales and my cost of goods sold. And you'd typically see that used where you have a low volume of sales and a high value of the inventory items.